Welcome back to the deep dive. Today we're conducting what I can only describe as an autopsy of the modern global economy. And I don't use that phrasing lightly.
Oh,
We're looking at an organism that has grown so large and so integrated into the fabric of our daily lives that it's effectively become invisible, just
yeah.
by virtue of its ubiquity.
It's the classic fish and water problem, right? You don't notice the water.
Yeah, I know.
It's everywhere. It's the environment you exist in.
Exactly. We are talking about Blackstone. And before we go any further, because I know a solid 40% of our listeners just pictured the wrong company logo in their heads, we are not talking about BlackRock.
No, we are not. Though, as we're going to unpack later, that confusion is actually a very interesting and, for one founder, a somewhat painful piece of financial history.
I can imagine.
But yes, today is about Blackstone, the private equity giant.
Giant feels like an understatement. It feels like calling the Pacific Ocean a large body of water. I was looking at the numbers from September 2025, just a few months ago. Assets under management, over $1.2 trillion.
It's a number that doesn't really mean anything. It's so big. To put that in perspective for you, that is larger than the GDP of most countries on Earth.
Most countries.
It's larger than the GDP of Saudi Arabia.
Yeah.
It is larger than the entire economic output of Switzerland. I mean,
Right.
if Blackstone were a country, you would have a seat at the G20.
And the premise of today's deep dive is really to answer the question, how? How do two guys, Stephen Schwarzman and Peter Peterson, start with just $400,000 in seed money in 1985
Just 400K.
and end up owning, well, basically everything?
And by everything, we are being hyperbolic. We mean the house you might be renting, the hotel you stay in for your vacation, the dating app you swipe on,
The song that's stuck in your head right now?
the song stuck in your head, the sandwich you eat for lunch, and very possibly the data center that is processing this audio file and streaming it to your device as we speak.
It is a wild, wild trajectory. We have a lot of ground to cover, from, the leveraged buyout boom of the 1980s to the AI data center wars of 2026.
Right.
But I want to start with the why. Why does a company like this even exist? What is the fundamental mechanism here? Because to the average person, private equity is just a buzzword,
It is.
and it usually implies layoffs and corporate raiders.
And that's the reputation, certainly. And look, it's not always an undeserved one.
Yeah.
But at its core, a firm like Blackstone is an arbitrage machine. They find gaps.
Gaps in the market.
Gaps in the market. They find assets that are undervalued or mismanaged or maybe just too complex for the public stock markets to really understand, and they take them private.
Away from the public eye.
Exactly. They fix them or financialize them, depending on how cynical you want to be, and then they sell them or take them public again for a massive profit.
So let's go back to the beginning. 1985, the era of Gordon Gekko, big shoulder pads, the Reagan boom. Schwarzman and Peterson decide to strike out on their own. Now, these weren't two scrappy kids in a garage inventing a computer, right?
Cuckles. Far from it. No, this is really important to understand about their origin. They were financial royalty from day one,
They came from Lehman Brothers.
both of them. And not just as analysts. Peter Peterson had been the chairman and CEO of Lehman. He was formerly the Secretary of Commerce under President Nixon. I mean, this guy was the establishment.
He knew everyone.
He had the Rolodex to end all Rolodexes. He could get anyone on the phone.
And Schwarzman, what was his role?
Schwarzman was the younger, hungrier shark. He was Lehman's head of M&A mergers and acquisitions. So you effectively have the statesman and the shark teaming up, the ultimate inside-outside combination.
I found this little nugget in the research fascinating. The name Blackstone, it sounds so solid, right? It's so institutional.
Like it's been carved into a building for 100 years.
Exactly, like it's been around since the 1800s. But it's actually a cryptogram, isn't it?
It's a bit of clever wordplay, yeah. It's a combination of their names. Schwarz is the German word for black.
Okay.
And Peter, or the Greek root, Petros, means stone.
Blackstone. Blackstone.
Blackstone. There you have it.
That is just, it's so clever. It's almost like a superhero alter ego name or a secret society.
Well, it certainly sounds better than Schwarzman and Peterson, which might have sounded a bit too much like a law firm or, an accounting practice on a quiet street somewhere.
Right.
They wanted something that projected strength, stability, power. But despite the clever name and the Lehman background, they really struggled initially.
Which is surprising to me. You'd think guys with that kind of resume, a former chairman of Lehman, would have investors lining up around the block to give them money.
You would think. Their plan was to get into the private equity business. basically doing leveraged buyouts, or LBOs. But back in '85, they had a credibility problem.
Oh.
Neither of them had ever actually led a leveraged buyout before.
Can we just pause and define that properly? Leveraged buyout. Because that is the engine of this whole story, and I want to make sure everyone is on the same page.
Sure. Let's use a real estate analogy because it's the most relatable for most people.
Yeah.
Imagine you want to buy a house that costs $1 million.
Ugh.
You put down $200,000 of your own cash, and you borrow the other $800,000 from the bank. That's leverage. You are using debt to amplify your buying power.
Okay, that's a standard mortgage. I get that.
Now imagine doing that with a company. You want to buy a company for, say, $1 billion. You put in $200 million of your investors' money, and you borrow the other $800 million. But here is the trick, and this is the magic and the danger of the LBO.
What's that?
You don't take on that debt yourself. You put that $800 million in debt on the company you just bought.
Oh, so the company now has to pay off the loan that was used to buy it in the first place?
Precisely. The company pays for its own acquisition. If it works, you, the private equity firm, make a massive, massive return on your small slice of equity because the debt did all the heavy lifting.
And if it fails?
Well, the company goes bankrupt because it can't service the debt you loaded onto it.
Yeah.
You might lose your $200 million, but the company is destroyed.
And that's why people hate LBOs. It puts this immense pressure on the company to cut costs, fire people, start spending on research and development just to service that debt.
Correct. And in 1985, potential investors looked at Schwarzman and Peterson and said, look, you guys are brilliant advisors. You're smart. You know how to tell other people what to do, but you've never actually run one of these. You've never had skin in the game. Why should we give you our money?
So they got rejected.
Repeatedly. The story goes they sent out 488 prospectuses. 488.
Yeah.
And they got rejected by almost every single one. It was a really humbling experience for two guys who were used to being masters of the universe.
So they had to pivot. This is the fake it till you make it phase, or maybe the do what you know to survive phase.
It's the do what you know phase. They went back to their bread and butter, advisory, mergers and acquisitions. Basically, hire us and we will tell you who to merge with and how to structure the deal.
And this kept the lights on.
It did more than that. It started building their reputation. And in 1987, they advised on the merger of E.F. Hutton and Shearson Lehman Brothers.
That was not a small deal at the time.
No, it was a huge Wall Street story. And the fee reflected that. That one deal netted them a $3.5 million fee.
Which, in 1987 money, is a serious war chest. That's enough to keep the office running for a very long time.
It gave them credibility, and it gave them breathing room. But then, history threw them a curveball. The universe handed them a gift, wrapped in a total disaster.
October 1987.
Black Monday.
Black Monday. Wait, usually a market crash kills a fledgling finance company. I mean, the Dow drops 22% in a single day. Panic in the streets. How on earth did Black Monday help them?
The timing was just uncanny. Just before the crash, they were finally, after all those rejections, trying to raise funds for their first real private equity fund. It was tough going.
Still.
But they managed to get the commitments to close the fund right before the chaos. So when the market crashed that October, stock prices plummeted. Suddenly, everything was on sale.
And Blackstone is sitting there with a fresh pile of cash.
A huge pile of what they call dry powder. They were ready to go shopping while everyone else was panicking and trying to sell.
It's the classic counter-cyclical strategy. Buy when there's blood in the street.
Precisely. In the aftermath of the crash, all these big institutional investors looked around and said, okay, the stock market is terrifying. We need someone who can go in and buy whole companies at these bargain basement prices. And Blackstone finalized their fundraising.
And who backed them?
The big players. We're talking Prudential Insurance, Nikko Securities out of Japan, and the General Motors Pension Fund.
And Nikko Securities actually bought a piece of Blackstone itself, didn't they?
They did. That was a huge vote of confidence. In 1988, they bought a 20% interest in Blackstone for $100 million.
$100 million. So that values the entire firm at $500 million, just 3 years after starting with $400K.
It's intense growth. It was a massive validation of their model. It allowed them to recruit heavy hitters like David Stockman from the Reagan administration. They were building a machine.
But while they were growing, there was this other partnership forming in the background. And this leads to one of the biggest what-ifs in modern financial history.
Oh, I know what you're talking about, the one that got away.
The BlackRock connection.
Yes. In 1987, Blackstone partnered with a guy named Larry Fink to found BlackRock. Initially, it was just a financial management arm operating under the Blackstone umbrella.
So just to be clear, at one point, Stephen Schwarzman and Larry Fink, who are probably the two most powerful men in finance today, were in the same office, working for the same team.
They were. They were colleagues. Larry Fink had been a star at a bank called First Boston, but he had blown up. He lost $100 million on a bad interest rate bet. He was kind of radioactive on Wall Street.
So he was looking for redemption.
Desperately. Schwarzman saw his talent, gave him a desk and some capital to start a bond management business.
But they were very different people, weren't they? With very different ideas about finance.
Fundamentally different philosophies. Schwarzman is the quintessential private equity guy. High risk, high reward, active management, buying companies, stripping them down, selling them for parts or fixing them up.
Taking big swings.
Taking huge swings. Fink, on the other hand, wanted to build a risk management machine. He was obsessed with it after his own blow-up. He was focused on fixed income, on safety, and eventually on passive investing. Very, very different mindsets.
And that friction eventually led to the split.
It did. By 1994, there was a dispute over compensation and how much equity ownership the BlackRock team should have. It got pretty contentious. And Blackstone decided to sell its stake in BlackRock to a company called PNC Financial Services.
And what was the sale price?
$240 million.
Okay, $240 million is a lot of money, especially in 1994. But considering what BlackRock is today.
Considering that BlackRock now manages something like $10 trillion. Yeah.
Ouch.
Stephen Schwarzman has gone on record calling it his heroic mistake, his worst business decision ever.
That has to sting. Every single time he sees Larry Fink on the cover of a magazine or speaking at Davos, he must just twitch a little bit.
You have to imagine so. But, it's not like Blackstone did too badly for themselves, obviously. While BlackRock went on to dominate the world of passive asset management and ETFs, Blackstone doubled down on private equity. And, crucially, they began expanding into other sectors.
Like hotels.
Yeah.
I noticed in the timeline that in the early 90s, they started buying up all these hotel franchises. Ramada, Howard Johnson, Days Inn.
That was a key move, led by a partner named Henry Silverman. This is so important because it really foreshadowed their massive pivot to real estate later on. They weren't just buying, anonymous industrial companies to strip them for parts.
They were buying operational businesses.
Exactly. Specifically in hospitality. They were learning how to run things, how to manage a brand, how to deal with customers, not just how to buy and sell a balance sheet.
So they're building this portfolio, surviving the 90s, the dot-com bubble bursts, and they get through that. And then we hit the 2000s, the era of the buyout boom. This is where things start getting really, really big, right?
The scale just shifts dramatically.
Yeah.
We enter the era of what was called the club deal.
Explain that to me. A club deal. It sounds like a VIP section at a discotheque or something.
Chuckles. Less disco, more debt. A club deal is when multiple private equity firms team up, they form a consortium, to buy a company that is simply too massive for any single firm to swallow on its own.
So it's like the Avengers of capitalism.
Or the Legion of Doom, depending on your perspective. Take the 2005 buyout of a software company called SunGard. That was an $11.3 billion deal.
Too big for one firm.
At the time, yes. So you had Blackstone teaming up with Silver Lake, Bain Capital, KKR, Goldman Sachs. Basically a who's who of Wall Street.
Why do it that way? Is it just to share the risk?
It's to share the risk and, frankly, just to pool enough capital to make the purchase. But these deals became very controversial because investors in the PE funds didn't always love them. They'd say, wait, I gave money to Blackstone and KKR to compete with each other for the best deals, not to collude and buy a company together.
It feels like it reduces competition.
It does. If all the potential bidders just team up, it keeps the final price down for them, but maybe it shortchanges the shareholders of the company being bought.
And they did more of these, right? Like the Freescale semiconductor deal.
$17.6 billion. That was the largest tech buyout ever at the time. But the real crown jewel, the deal that absolutely defined this era for Blackstone, was Hilton.
The Hilton Hotels deal in 2007.
Yes. Blackstone acquired Hilton Hotels for $26 billion. All cash.
$26 billion. And the timing of this was mid-2007, right before the 2008 financial crisis.
I mean, literally at the peak of the market. In the industry, this is often cited as the high water mark of that pre-crash LBO boom. They bought it at a huge premium when asset prices were at an all-time high. When the crash hit in 2008, it looked like an absolute company-killing disaster.
Everyone must have thought they were going to lose their shirts. I mean, if you or I bought a hotel chain in 2007, we would have been bankrupt by 2009.
Many were. But this is where Blackstone's strategy, and frankly just having incredibly deep pockets, came into play. They didn't panic and sell at the bottom.
They held on.
They held on. In 2010, they went back to the lenders and restructured the massive amount of debt on the company.
Yeah.
They convinced them to give them more time and better terms.
Because the lenders would rather get paid later than have Hilton go bankrupt and get nothing.
Precisely. Blackstone then poured money into the properties. They improved operations. They expanded internationally. They held on for years.
They waited out.
They waited it out and improved the asset while they waited. Eventually, when the economy recovered, they took Hilton public again. And it became one of the most profitable private equity deals in history. They netted a profit of something like $14 billion.
That's the difference, I guess. If I buy a house at the top of the market and the market crashes, I'm in trouble because I can't make the mortgage. If Blackstone does it, they rewrite the mortgage.
It's an oversimplification, but yes. They have the leverage and the scale to negotiate with lenders in a way that you or I simply do not.
And speaking of negotiating, we have to mention the equity office acquisition. That was in 2006. This one is even crazier in terms of tactics and timing.
Oh, this is the bidding war, right?
A massive one.
Blackstone wanted to buy equity office properties, which was one of the largest owners of office buildings in the entire U.S. Another big real estate player, Vornado Realty Trust, jumped in and started a bidding war, which drove the price up and up and up.
Blackstone eventually won.
They won, but they paid $39 billion for it. At the time, the largest LBO in history.
$39 billion for office buildings right before the office market crashed and the concept of remote work started to percolate. That sounds like a disaster waiting to happen.
It would have been a complete catastrophe if they had held on to all of it. But here is the genius or the luck of it. They closed that deal and immediately started selling off pieces of the portfolio.
Immediately, like the same day.
Practically. They had deals lined up before they even owned it. They flipped about half the portfolio within weeks and months. They sold the big trophy buildings in New York, in Boston, in Seattle to other investors at peak 2007 prices.
So they effectively offloaded the biggest risk to other people right before the music stopped.
Exactly, before the crash. Yeah. If they had held all of that prime, expensive real estate through 2008 and 2009, it might have dragged the entire firm down. Instead, they sold the expensive trophy assets and kept the more boring suburban office parks that had higher yields and less risk.
The timing is it's incredible. It feels like they had a crystal ball.
Or they just had a very good sense that the market was overheating and it was the perfect time to sell some risk to the public. Which brings us perfectly to their own IPO.
June 2007.
Again, literally months before the world economy completely falls off a cliff.
They went public, raising over $4 billion. Stephen Schwarzman and Peterson cashed out a significant portion of their personal stakes right at the absolute top of the market.
It was the ultimate ringing the bell moment. It fundamentally changed the firm. They were no longer just a private partnership accountable to a few big investors. They were a public company with shareholders to please every single quarter.
So, the crash happens. 2008 is a complete mess. But Blackstone survives. And then, starting around 2009, they pivot. And this pivot is what really leads us to the Blackstone we know today.
The post-crisis era is fascinating. While everyone else was licking their wounds and deleveraging, Blackstone went shopping. They focused heavily on distressed assets. And the biggest distressed asset class in America, by far, was housing.
This is the part of the story that I think people feel the most visceral connection to. They started buying single-family homes.
On an industrial scale, this is where the narrative shifts from Wall Street sharks eating each other to Wall Street sharks eating Main Street.
Right. The foreclosure crisis is in full swing. Millions of Americans are losing their homes. Housing prices are at rock bottom.
And Blackstone looks at this and sees the single biggest distressed asset opportunity in history. They founded a subsidiary company called Invitation Homes. They went into markets that were hit the hardest, like Phoenix, Atlanta, all over Florida and California.
And they weren't just buying a few houses here and there.
No. They had teams buying them on the courthouse steps. They were buying them in bulk from banks. They spent roughly $5.5 billion buying around 50,000 single-family homes.
50,000. And instead of flipping them, their strategy was to rent them out.
Yes. They totally institutionalized the landlord business. Before this, being a landlord was a mom-and-pop thing. You owned 2 rental units, maybe 5. Blackstone built a massive technological platform to manage 50,000 homes efficiently, using algorithms for maintenance requests, rent collection, and, crucially, for pricing.
Pricing, that's the key word there. Because when you own that much of the rental stock in a particular neighborhood or city, you have a lot of power over rent prices.
A tremendous amount of power. And this is where the controversy explodes. Critics, including the United Nations later on, argued that by buying up so much of the available supply, they drove up prices for regular people trying to buy a first home, and then by maximizing rents with their algorithms, they squeezed tenants.
They turned the American dream of homeownership into a monthly subscription service paid to a private equity firm.
That is the cynical, but not entirely inaccurate take. Blackstone would argue they renovated tens of thousands of dilapidated homes, they professionalized the rental market, and they provided high-quality rental stock at a time when banks weren't lending to anyone to buy a house. They'd say they provided a vital service.
It's all a matter of perspective, I suppose, but it definitely marks a shift. Blackstone is now squarely in the consumer business. They aren't just buying companies anymore. They were buying the literal infrastructure of daily life.
And not just houses, theme parks.
Right. In 2009, they bought Busch Entertainment, that's SeaWorld and Busch Gardens, for $2.9 billion.
And they bought Merlin Entertainments, the company that owns Legoland and Madame Tussauds wax museums.
They bought them twice, actually. They owned them back in 2005, sold them, and then bought them back again in 2019.
They really like Legos. Or more accurately, they really like the steady, recurring revenue of families looking for experiences.
But if you look at the portfolio expansion from, say, 2010 to 2020, you see this very clear move toward consumer brands and technology. They bought Ancestry.com in 2020 for $4.7 billion.
Which raises some eyebrows, doesn't it? A private equity firm owning the genetic data, the DNA of millions of people.
It definitely raised a lot of privacy questions at the time, but from a pure investment standpoint, it's a brilliant business model. It's a subscription service with a massive proprietary data moat.
They also invested in Oatly, the oat milk company.
Which was huge for a while.
They bought a majority stake in Bumble, the dating app, and they bought Spanx.
Spanx. And I read that the Spanx deal was handled by an all-female investment team at Blackstone, which was a big deal.
It was. And they set up an all-female board of directors for Spanx as well. It's a very clear signal that they were trying to modernize their image and tap into markets that traditional male-dominated finance had perhaps overlooked or undervalued in the past.
So we've moved from these, boring industrial buyouts of the 90s to oat milk, dating apps, and shapewear in the 2010s.
Exactly. They moved into owning culturally relevant brands. But as we move into the 2020s, specifically the last few years leading up to today in 2026, the strategy shifts again. It becomes what I call the everywhere strategy.
This is where the numbers get truly astronomical. We're talking about the modern era, 2021 to now.
The post-pandemic world. Blackstone went on a shopping spree that makes the 2007 boom look modest by comparison.
Let's talk about real estate first, because they didn't stop with houses. They went for, everything else.
Hotels and hospitality, again, in a big way. They acquired Crown Resorts in Australia for $6.6 billion. They bought the Cosmopolitan Hotel in Vegas, then sold it for a huge profit. They did a sale-leaseback deal for the famous Bellagio.
And student housing. I remember this one making headlines.
April 2022. They bought a company called American Campus Communities for nearly $13 billion.
$13 billion.
With that one deal, they effectively became the landlord for tens of thousands of college students all across America.
But the biggest real estate play, and this is the one that really positions them for the future, is data centers.
This is the AI boom play. This is everything.
Let's unpack this, because when I think Blackstone, I think physical buildings. I think hotels and offices. I don't think artificial intelligence.
But you cannot have AI without immense physical infrastructure. ChatGPT, Claude, Gemini, they don't live in the cloud. That's just a marketing term.
Right.
They live in massive servers.
Yeah.
Those servers need to live in massive windowless buildings. They generate an incredible amount of heat, so they need industrial scale cooling. They consume gigawatts of electricity.
So the cloud is actually a very large, very hot, very expensive warehouse.
A series of them, yes. And Blackstone saw this coming years ago. In 2021, they acquired a data center company called QTS Realty Trust for $10 billion. But the real monster deal was just recently, in September of 2024, the acquisition of AirTrunk.
AirTrunk. It sounds like a luggage company, but it's not.
Far from it. It's a massive data center platform in the Asia-Pacific region, Japan, Australia, all the key markets. The enterprise value of that deal was over 24 billion Australian dollars.
That is a staggering amount of money for server
But
farms.
think about the demand. Every time you use an AI assistant or stream a 4K movie or use any cloud computing service, that data has to live somewhere physically. By owning the data centers, Blackstone is owning the physical backbone of the entire digital economy.
It's the 21st century equivalent of owning all the railroad.
It is precisely that. If you are Amazon or Google or Microsoft, you are in an arms race for AI dominance and you need capacity now. You don't have time to build it all yourself, so you go and lease it from Blackstone.
And while they are building the digital railroad of the future, they are also buying your lunch.
Chuckles. The sandwich strategy.
Okay, let's talk about the sandwiches, because this is the part that feels so random at first glance, but obviously isn't.
It's part of a very specific, very deliberate strategy. In 2024, they bought a tropical smoothie cafe. They invested in a company called 7 Brew, which is a fast-growing drive-through coffee chain. And then, the big one that completed just last year, January 2025, they bought Jersey Mike's Subs.
So why sandwiches? Why coffee? Why is the master of the universe buying a sub shop?
Because of cash flow and resilience. Think about the economic environment of the last 2 years. High inflation, rising interest rates, a lot of volatility. What is the one thing people don't stop doing?
Eating.
They eat. And specifically, in tough times, they trade down. Maybe you don't go to the expensive steakhouse, but you will still buy a $12 sub. It's a recession-resistant business. And it fits into this broader theme of investing in things people need or habitually use.
And it's a franchise model, right, which means they aren't actually running the stores.
Exactly. Blackstone isn't in the back making the sandwiches. They're collecting the royalties and franchise fees from the thousands of franchisees who do the hard work. It's a steady, predictable royalty stream, just like the music catalog they bought.
Hypnosis.
Right. July 2024. They won a bidding war to buy Hypnosis Songs Fund. Now, through a company they rebranded as Recognition Music Group, they own the rights to the catalogs of Justin Bieber, Shakira, and Neil Young.
So let's trace the dollar here for a second.
Yeah.
Let's say I wake up in a house that's owned by Invitation Homes, that's Blackstone. I check a dating app, Bumble. Blackstone owns a major stake. I drive to work and listen to a Justin Bieber song on the radio, Blackstone gets a tiny cut. I grab a Jersey Mike sub for lunch, Blackstone. I go home and watch Netflix, which is streaming its data from an air trunk data center, Blackstone again.
You are living from morning to night inside the Blackstone ecosystem.
It's almost a modern company town model, but on a global, invisible scale.
And looking at their financials, it's clearly working. The numbers are undeniable. As of their 2024 reports, their revenue jumped to over $13 billion. Net income nearly doubled to $2.77 billion. And as we mentioned at the start, assets under management hit $1.43 trillion in 2024 and crossed $1.2 trillion by September 2025.
They are the largest alternative investment firm on the planet.
By a very significant margin. They operate on 4 main pillars. Real estate, which is the biggest chunk of private equity, hedge funds, and credit. It's a massive, diversified machine designed to generate returns in almost any market condition.
But, and there is always a but, when you get this big and this powerful, you can't own everything without stepping on some toes. Or, in some of these cases, causing very real, very tangible harm.
No, you absolutely cannot. And Blackstone has faced a series of significant and disturbing controversies, particularly in recent years. We have to talk about the dark side of this relentless efficiency.
The one that really, really sticks with me because it's so horrifying is the child labor scandal at PSSI.
Packers Sanitation Services, Inc. This is a company owned by Blackstone. They provide third-party cleaning and sanitation services for slaughterhouses and meatpacking plants.
A gruesome, dangerous job to begin with.
One of the most dangerous jobs in America. In 2023, the Department of Labor found that over 100 children, some as young as 13, were working illegally for PSSI.
We're talking about kids working overnight shifts, cleaning back saws and skull splitters with caustic industrial-strength chemicals.
Yes. There was a report of a student at a middle school who fell asleep in class and had visible acid burns on his hands and knees from his shift the night before.
That is just dystopian. How does a sophisticated multi-trillion-dollar firm like Blackstone let this happen in one of its companies?
Blackstone's official defense was that they were horrified and they didn't know. They're in a tower in Manhattan. They aren't on the ground in Nebraska hiring people. They said PSSI had its own local management. Blackstone immediately settled the case, PSSI was fined $1.5 million, and they implemented new, stricter hiring protocols.
But critics of the industry point out that this is a structural problem, right? It's a feature, not a bug, of the model.
Critics argue that the private equity model, which demands relentless efficiency and ever-increasing profit growth, creates a pressure cooker environment. Local managers are told to cut costs and keep the line moving no matter what. Hiring undocumented miners who are desperate for work is a cheap, tragic way to do that.
It's that complete disconnect between the boardroom in New York and the slaughterhouse floor in Nebraska. We just demand the returns. We don't tell you how you get them.
Exactly. And we saw a different version of this same kind of operational disconnect with the Motel 6 scandal.
Right. This was a few years back, 2018, 2019.
Motel 6, which was Blackstone owned at the time, admitted that some of its locations were giving their daily guest lists to agents from IC Immigration and Customs Enforcement without warrants.
So people were checking into a motel thinking they had a reasonable expectation of privacy, and the motel staff was essentially tipping off immigration authorities if they had Latino-sounding names.
That's effectively what was happening. They ended up settling lawsuits for nearly $20 million combined. But the reputational damage was significant. It raised these really serious questions about privacy and civil rights within these massive corporate structures.
And then there's the housing controversy. We talked about them buying up houses, but it's not just about ownership. It's about how they act as landlords on a massive scale.
The United Nations actually condemned their practices in a formal report. A UN special rapporteur accused them of contributing to the global housing crisis by buying up so many properties, which inflates rents, and then engaging in aggressive eviction tactics.
And this wasn't just in the U.S.
No, the report cited specific issues with a company they owned called Southern Cross in the UK and apartment blocks in Denmark. It was a global issue.
And even their own investors got spooked by the real estate holdings recently.
The Bright saga, yeah. Bright is their massive, non-traded real estate investment trust for wealthy individuals. In late 2022, investors started getting very nervous about the commercial property market, and they tried to pull their money out.
And there was a run on the fund.
A huge run. There were so many withdrawal requests that Blackstone had to invoke its right to limit them. They call it gating the fund to prevent a collapse.
Which is terrifying if you're an investor. You're told your money is safe, and then you say, I want my money back, and they say, sorry, you can't have it right now.
It eventually stabilized, but it showed that even a giant like Blackstone isn't immune to market panic. Real estate is fundamentally illiquid. You can't sell a skyscraper in an afternoon because Mrs. Smith from Ohio wants her $50,000 back.
And as we talk about the company's recent history, we can't ignore the tragedy that happened just last year in the summer of 2025.
Yes. It's a very somber and terrible note in their corporate history. In July of 2025, a gunman named Shane Devin Tamura entered Blackstone's global headquarters at 345 Park Avenue in Manhattan.
This sent absolute shockwaves through the entire financial community and the city.
It did. 4 people were killed. And among the victims was Wesley LePatner, who was a senior managing director and the CEO of that massive real estate fund we were just talking about, Bright.
It's just a stark, awful reminder that behind these trillions of dollars and massive global portfolios, there are actual human beings.
Absolutely. It was a tragic, senseless event that really shook the firm and the whole industry to its core.
So we've looked at the history, the massive deals, the sandwiches, the data centers, and the very serious controversies. When you step back and you look at Blackstone today, in February of 2026, what do we actually see?
I think we see something that's evolved beyond being just an investment firm. It's a state within a state. Blackstone doesn't just move money around anymore. They own the core infrastructure of our daily lives. Food, shelter, data, music.
And it highlights this massive shift from public markets to private equity.
That's such a key point. When a company is public, listed on the stock market, there are all sorts of disclosure requirements. You can see the books. They have to file quarterly reports to the SEC. You have some transparency.
But when Blackstone takes a company private, like they did with so many of these huge acquisitions, that transparency just vanishes.
It goes away. So huge sectors of our economy, housing, student accommodation, data centers, logistics, are moving into this black box where we, the public, can't really see how they're being run.
So that brings us to the so what for the listener. Why does this matter?
Right. Why should the person listening to this care, other than it being a kind of mind-boggling business story?
Because it affects them directly, every day.
Because you interact with Blackstone almost every single day, and you probably don't even know it. Your rent might be determined by their algorithms. The long-term privacy of your genetic history on Ancestry is in their hands. The data centers powering your AI tools are theirs.
It's really about control.
It is. I mean, at what point does investment become control? If a single firm owns the rights to your genetic history, the songs stuck in your head, the house you want to rent, and the sandwich you eat for lunch, who is watching the watchers?
Especially now that they are literally building the physical backbone of the future economy with these data center deals.
Exactly. They are making enormous, multi-billion-dollar bets on the future of humanity, what we will eat, where we will live, and how we will compute. And right now, by almost any measure, they are winning that bet.
From $400,000 on a clever cryptogram name to $1.2 trillion and the keys to the kingdom, it is a wild ride.
It certainly is.
So, final question. Is Blackstone good or bad, or is that just the wrong question to ask?
I think it's the wrong question. Blackstone is efficient. It is, perhaps, the ultimate expression of modern capitalism. It exists to seek yield. If the highest yield is in curing cancer, they will invest in life sciences, and they're doing that. If the highest yield is in squeezing an extra $50 a month in rent from a family, their model will compel them to do that too. It is an amoral machine.
And it is up to the rest of us and our regulators to decide where the guardrails should be.
Exactly. The machine will not stop itself.
Well, on that cheerful note, I'm going to go check my dating app, order a sandwich, and listen to some music. And I'm going to try very hard not to think about who gets the transaction fee for each of those things.
Good luck with that. It's
Yeah.
almost unavoidable at this point.
That's all for this week's Deep Dive. We'll see you next time.